Coming now to what I believe is the most important section in this reading, common ratios used in financial analysis. What we'll do first is identify the different categories. We can have activity ratios, which essentially measure how efficiently a company is performing. A classic example of an activity ratio is revenue divided by assets. This is also called the asset turnover ratio. This is showing that per unit of assets, how much revenue is a company generating. There are several other activity ratios which we will see on the next slide. Liquidity ratios we have seen before in the reading on the balance sheet. Solvency ratios were also discussed in the balance sheet reading. Profitability ratios we saw briefly in the income statement reading. They tell us about the profitability of a company. Examples would include net income over sales, and here we will also look at mixed ratios where the numerator comes from the income statement and the denominator comes from the balance sheet. Valuation ratios we will touch briefly in this reading, but we will see in a lot more detail later when we study equity and fixed income. Essentially here we are looking at the quantity of an asset or a flow on a per share basis. A classic example would be EPS, or we might also have ratios such as price to earnings ratios. In earlier readings, we generally focused on single statement ratios. So we had ratios from the income statement such as the gross profit margin, operating margin, or net profit margin. Then from the balance sheet, we had liquidity ratios and solvency ratios. And with the cash flow statement, we had ratios that took a numerator and a denominator from the cash flow statement. Now we will spend a lot of time on mixed ratios where the numerator comes from the income statement and the denominator from the balance sheet. The numerator could also come from the cash flow statement. As a general point, you need to be careful about how you interpret ratios. The interpretation should be in the context of the goals and strategy of the company that you are evaluating, industry norms and economic conditions. Let me elaborate. Consider two companies, Intel and AMD. They are in the same business. Both make chips, but they follow different strategies. Intel is a market leader. It tries to come up with new and innovative products, whereas AMD is a follower. AMD essentially tries to copy what Intel is doing. That is putting it very simplistically. Clearly, even though the two companies are in the same industry, but they follow different strategies, so chances are that their ratios will be different. Clearly, the R&D expenditure for Intel will be much more than the R&D expenditure for AMD, which might imply that overall the asset, assuming that R&D is eventually capitalized, the assets for Intel might be higher, relatively speaking. Without getting into the details, the point is that these different strategies impact ratios. So when we compare the two companies, we need to be aware that the goals and strategies are slightly different. Industry norms is a very important point. Clearly, a ratio is good or bad depending on how that ratio is relative to the standard in the industry. The current ratio in a given industry might be 1 on average, whereas in another industry the current ratio might be 0.3. So when you are coming up with the ratio for a company, it needs to be looked at in the context of the industry. Economic conditions means that the ratio you come up with should be considered with respect to the current state of the economy. If the economy is in a recession, then in general net income and operating income will be low, so profitability ratios are likely to be low. On the other hand, if the economy is booming, then the profitability ratios are likely to be high. Let's take a deeper look at activity ratios. Here are the activity ratios that you essentially need to learn, and over the next few slides I will take you over these ratios and help you understand what they mean, help you interpret them, and help you remember them. Let's start with the first one, which is extremely important, the inventory turnover ratio. The formula is cost of goods sold divided by average inventory. And the interpretation of this ratio is that it tells us how many times per period was the entire inventory sold. This is a theoretical number, it's an approximation, but just to let you understand where this is coming from, think of it this way. Let's say that over a period, the COGS for a company was 200, and during this same period, on average, the inventory was equal to 10. The inventory turnover ratio then is 200 over 10, which is 20. So what is the interpretation of 20? This is approximately the number of times per period, so this period, that the entire inventory was sold. Now, a few more remarks about this ratio. Notice that the income statement item is in the numerator and the balance sheet item is in the denominator. We also use average inventory. The point is that if at the end of the year it just turns out that the inventory number is very high because the company is building up for the next year, but in general during the year the inventory was maintained at 10, then clearly it makes sense to use 10 as your denominator and not 25. As a financial analyst, however, you might not know the exact average inventory. So what you would normally do is use the average of the beginning period inventory, which you can get through the financial statements, and the ending period inventory. The principle though is that you should ideally use the average. If you don't have those numbers, you just have the end of period number, then that's what you use, hoping that the end of period number is indicative of the average inventory during the year. If you have access to quarterly reports and you have inventory numbers for the end of every quarter, that is very good because then you can get a more accurate average inventory number by using all the end of quarter numbers. This should be obvious, but I will state it anyway. A higher number for the inventory turnover ratio shows greater efficiency. If you have another company that manages to have a lower inventory balance with the same cost of goods sold, that means it is managing its inventory better and it might have a higher turnover ratio such as 25. You also need to understand this item, days of inventory on hand. This is calculated by taking the number of days in a period. So if we are taking a 1 year period, then we have 365 days in a period divided by the inventory turnover ratio. In our simple example, if we have 365 divided by 20, then the days of inventory on hand is 18.25. This is a measure of, on average, how many days of inventory do we maintain. Obviously, if the activity ratio is higher, then that means that on average we maintain a lower amount of inventory. Receivables turnover ratio. This is the revenue divided by average receivables, and this measures how quickly a company collects cash. Generally, it would be more appropriate to use credit sales divided by average receivables rather than revenue, but often credit sales numbers are not available. Therefore, analysts tend to use the revenue number. A higher number for this ratio shows greater efficiency. We also need to calculate the days of sales outstanding. This again is the number of days in a period. If we are considering a year, then we have 365 days divided by the receivables turnover ratio. If this number is large, that means that it takes us a long time to collect our receivables. Payables turnover ratio. This is purchases divided by average trade payables, and the interpretation is the number of times per year that a company pays its supplier. As an analyst, you might not have access to the purchases account. Then what you use is the cost of goods sold plus change in inventory. If you have a given period where COGS is equal to 200, the inventory at the start of the year was 10 and at the end of the year is 30, then this means that the purchases must have been 200 plus the change, which is 20. So purchases must have been 220. So that is the precise measure to use. At times, an analyst might simply use purchases as approximately equal to COGS. In terms of interpreting the numbers, a relatively high number for the payables turnover ratio would mean that a company is not making good use of credit facilities. A very low ratio might indicate possible liquidity problems. The working capital turnover ratio is revenue divided by average working capital. This tells us how efficiently a company generates revenue from its working capital. And just to remind you, working capital is equal to your current assets minus current liabilities. At times, if the current assets and current liabilities are roughly the same, then this number would be approximately 0 and the ratio would be meaningless. We can also look at the fixed assets turnover ratio and the total assets turnover ratio. The total asset turnover ratio is revenue divided by average total assets, and this tells us how efficiently a company generates revenue from total assets. We have looked at several ratios, and you might be wondering how you can remember them. I'll give you a very simple technique that will make it easy for you. The first point is that the name tells you the balance sheet item. Notice that in all these ratios, you have an income statement item in the numerator and the balance sheet item in the denominator. With the receivables turnover ratio, we have average receivables over here. With the total asset turnover ratio, we have total assets over here. So clearly, you know the balance sheet item based on the name. From the balance sheet item, you can determine the relevant income statement item. If we have assets in the denominator, the relevant item in the numerator is revenue. If we have inventory as your balance sheet item, then the relevant item would be cost of goods sold. So based on the balance sheet item, you can figure out the relevant income statement item. As I've already mentioned, the income statement item is going to be in the numerator for our activity ratios. And then also notice that in general with the balance sheet item, we use a average value. If you can remember these 4 points, then that will allow you to remember all the activity ratios. The liquidity ratios are shown over here. We have already talked about them in the reading on the balance sheet, but very briefly, liquidity ratios give us an understanding of how easily a company can meet short-term obligations. The ratio that we didn't see before is the defensive interval ratio. This looks at the current assets divided by the daily cash expenditures. So if the current assets are 100 and the daily cash expenditure equals 10, then our defensive interval ratio is 100 over 10, which is 10. This essentially means that we have 10 days worth of short-term assets. So we can meet 10 days worth of daily expenditures. Now, some interpretation and judgment can come in. If you believe that receivables are not very liquid, then it might make sense to remove your receivables number when coming up with the defensive interval ratio. We can also evaluate the liquidity of a company by looking at the cash conversion cycle, which is also called the net operating cycle. This essentially measures the time between when a company spends money on inventory till the time that the company receives money on the sales that it makes. Obviously, if this period is short, that means high liquidity. If this period is long, that means low liquidity. The formula for calculating the net operating cycle is days of inventory on hand plus days of sales outstanding minus number of days of payables. To understand this formula, let's look at a simple example. Let's say that a company orders inventory over here. So this is where the inventory is received. Then the payment for that inventory happens 10 days later. So on day 10 is when we make the payment. So this is where money goes out. Let us say that the days of inventory on hand is 30, which means that it takes us 30 days to convert this inventory into product which is sold. That means that on day 30 over here is where the sale happens. And then on average, let's say that it takes 15 days to collect money. This sale, for example, is a credit sale. And on day 45 is when we receive money. The net operating cycle or the cash conversion cycle is the time period from here to here. What is that? If you look at the days of inventory on hand, that is this point to this point. So that is 30. The days of sales outstanding, that is equal to 15 from here to here, minus the number of days of payables, which is 10. So the cash to cash cycle or the cash conversion cycle, as you can see from this picture, is 45 minus 10, which is 35. You get the same answer using the formula. So 30 and 15 is 45 minus 10 is 35. And again, a relatively high number would mean low liquidity and a short number means high liquidity because the company is getting cash back very fast. Solvency ratios we have discussed when we talked about the balance sheet. Just as a refresher, the ratios are given again, and these ratios measure a company's ability to pay back long-term debt. If you look at the debt to asset ratio, then small amount of debt relative to a large asset base means that the company is financially strong, the leverage is low, so we are not too concerned about whether or not the company will be able to pay off debts if this number is small. So notice that with debt to asset ratio, low is good. Debt to capital, so capital generally refers to the total money that has been raised, that's debt as well as equity. This should be low. Debt to equity ratios, again, low is safer. Financial leverage ratios, this is important. Here we divide total assets divided by equity. Now, a high ratio here means high leverage. So, in general, with these ratios, a high ratio means that there is a high level of debt or high level of leverage. And as we've discussed before, you need to look at these numbers in the context of the industry, because in some industries the level of debt or leverage will be high, in other industries the level of debt or leverage will be low. Some more solvency ratios. An extremely important one is the interest coverage ratio, which is your operating income or earnings before interest and taxes divided by interest payments. This is called a coverage ratio because if this ratio, for example, is 10, what that means is that your operating income covers the interest amount 10 times. Here, the higher the better. A high coverage ratio means that you are making a lot of operating income relative to the financial cost, which is interest in this case. Fixed charge coverage, this is EBIT plus lease payments divided by interest payments plus lease payments. You will understand this better when we do the chapter on long-term liabilities and leases later, but just to give you a very brief explanation. In the numerator, we use EBIT plus lease payments because typically EBIT is calculated after making lease payments. By adding back lease payments, we are looking at how much money we are making before the lease payments. Just like over here, we are looking at how much money we are making before making interest payments. So here we have the amount of money we make before lease payments divided by the total payments. Just like interest payments are an obligation, similarly, lease payments are also an obligation. So it makes sense to look at the sum of the two numbers. The profitability ratios that you are looking at here should seem very familiar. You saw these ratios when we did the income statement. Essentially, higher the better. Gross profit margin is the gross profit divided by revenue. Operating profit margin is operating income over revenue. Pre-tax margin is earnings before tax over revenue, and net profit margin is net income over revenue. Profitability ratios, where we look at the return on investment, these are mixed ratios. You will often see this particular ratio, return on assets. Return on assets is net income, which you get from the income statement, divided by average total assets. And the theme that I talked about earlier in terms of the income statement number in the numerator and the average balance sheet number in the denominator continues over here. Return on total capital is EBIT divided by short and long-term debt and equity. Now, in different textbooks, you might see a slightly different definition of capital. Here you see long-term debt and equity. In other textbooks, the total assets might be used. Return on equity is net income divided by average total equity. Return on common equity looks at the money that is available to common shareholders. If you recall your EPS calculation, you saw this expression there also. The net income minus preferred dividends is the amount available to common shareholders divided by average common equity gives you the return on common equity. Coming now to the DuPont analysis, which is important from a testability perspective. This brings together several ratios that we are talking about. Return on equity is net income divided by equity. This is an important ratio because it tells us how much net income we are generating relative to the equity or the amount that we have invested. Let's say that this particular ratio is 20%. That looks like a good number. Let's say that this is higher than the industry average, which say is 15%. The question then becomes the following: where is this 20% coming from? And DuPont helps us with that analysis. We can think of net income over equity or return on equity as the product of return on assets and financial leverage. Return on assets is net income divided by total assets, and financial leverage, as we have seen on an earlier slide, is assets divided by equity. Notice that when you multiply these two expressions, the assets cancel out and you have net income divided by equity. So it is possible that we have a high net income over equity because of high leverage. High leverage means that our own equity investment is small, debt is high, which is why even though net income over assets is a small number, so let's say that this number is only 10%, but if assets over equity or financial leverage is 2, that will give us a net income over equity of 20. By decomposing net income over equity into these two ratios, we actually see that our 20% number is coming because of high leverage or high risk. Taking this one level further, we can say that return on assets can be written as net profit margin divided by total asset turnover. So the net profit margin is net income divided by sales, and total asset turnover is given by sales divided by average total assets, and then the financial leverage term comes down. This has not been decomposed, so this is still assets over equity. Now, if you multiply these three ratios, you notice that again you are left with net income over equity, because sales and sales cancel, assets and assets cancel. So again, this tells us that the return on equity is partly explained by leverage, but this decomposition, return on assets as the product of net profit margin and total asset turnover, tells us that the return on assets has these two components. We have a net profit margin, which tells us about our profitability relative to sales, and the asset turnover, which tells us how efficiently we are using our assets. And with a 10% number, it might be because we are using our assets very efficiently. So it is possible that net income over sales is only 5%, but sales divided by assets is 2, which means that our real value is coming because of our efficient use of assets and not because we are very profitable in terms of net income over sales. Now, to summarize what we've discussed so far, I think from an exam perspective, understanding the two kinds of DuPont ratios is extremely important. So I will erase what you see over here and just summarize the two types of DuPont ratios that you must be on top of. So return on equity is net income over equity. This can be written as return on assets, which is net income over assets, multiplied by financial leverage, which is assets over equity. And then decomposed into three components, we can say return on equity is net income over equity, which is equal to net income over sales times sales over assets, that's the total asset turnover, times the financial leverage, which is assets over equity. While I don't think you are likely to be tested on this, but you might as well also learn the 5-form decomposition of the return on equity. So here we essentially say that return on equity is equal to tax burden into interest burden into EBIT margin, and all these numbers essentially are coming from the income statement. So we can look at net profit margin as coming from three sources. One is EBIT margin, which is saying how efficient our operation is. The next is interest burden, which tells us about our finance costs. So if the finance cost is low, then this ratio will be high. And tax burden, which tells us about the tax. If the tax is low, then this ratio will be high. And I will create a very simple balance sheet to illustrate this concept. Notice that our net profit margin can be written as the product of these three ratios. So net income over sales is equal to net income over EBT, earnings before tax. A high number for net income over EBT means that the tax is low, multiplied by EBT over EBIT, so this divided by EBIT. A high number for this ratio means that interest is low. And then EBIT over sales, this is our operating profit margin. A high number means that our operating expenses are low. So the 5-form DuPont equation then becomes net income over EBT times EBT over operating profit times operating profit over sales times the total asset turnover, which is sales divided by assets multiplied by the financial leverage, which is assets over equity. Again, I will emphasize that you must know these two forms: net income over assets times assets over equity, and this form that essentially has three ratios: net profit margin, asset turnover, and financial leverage. Let us look at a problem which is a little bit difficult but illustrates the concepts we have spoken about. Over a 3-year period, we are looking at the ROE of a company, which is going up from 19% to 20% to 22%. The return on total assets is coming down. This tells us that the profitability of the company is coming down. Total asset turnover is going up slightly. So initially it is 2, and then in 2012 it is 2.1. We need to make an assessment about the net profit margin and financial leverage. And we'll do this by decomposing the ROE. If we look at the most basic form of the DuPont equation, that tells us that return on equity is equal to return on assets multiplied by financial leverage. Looking at the top row, we know that ROE is going up. Looking at the second row, we know that the return on total assets is coming down. Therefore, the leverage must be going up. So the financial leverage has increased. This means that we can rule out A and the answer must be B or C. If you take net income over assets, or the return on assets, this ratio can be decomposed into the net profit margin, net income over sales, multiplied by the asset turnover ratio, sales over assets. We know that return on assets is coming down from the second row. Net income over sales, that is the profit margin that we need to evaluate. Sales over assets, or asset turnover, this has been going up a little. The only explanation now is that net income over sales, or profit margins, must be going down. So the correct answer is C. Net profit margin has decreased, but financial leverage has increased. Coming now to equity analysis, here we'll have a very high level discussion because there is a full topic on equity and this material will be covered in detail over there. The high level steps for equity valuation: you need to understand the business and the existing financial profile of the business, forecast the company performance, select an appropriate valuation model. And when you do equity analysis, you will notice that we can have models based on ratios, models based on discounted cash flows, models based on value of assets and liabilities. We then convert the forecasts into a valuation and make an investment decision. In this particular reading, we are focused on ratios, and there is substantial evidence that ratios are useful in forecasting earnings and stock returns. Some of the important valuation ratios for equity are price to earnings. This is the price per share divided by the earnings per share, price per cash flow, price per sales, and price per book value. The book value of a company is also called the net asset value, or the value of assets minus the value of liabilities. We've already talked about some of these ratios before: basic EPS and diluted EPS. We did this in the reading on the income statement. Cash flow per share tells us the total cash flow from operations divided by the weighted average number of shares. EBITDA is sometimes used as a quick proxy for cash flow. EBITDA per share is simply EBITDA divided by the weighted average number of shares. Dividends per share, this is the common declared dividends divided by the average number of ordinary shares outstanding. Industry specific ratios. Some high level remarks over here. As has been mentioned before, there is no universally accepted definition or classification of ratios. Ratios simply serve as indicators of performance and value. Now, there are aspects of performance which are relevant in one industry but which might be completely irrelevant in another. Hence, you will often notice the use of industry-specific ratios. From an exam perspective, I don't think you need to memorize the industry-specific ratios, but if you look at Exhibit 19 in the curriculum, it gives you a sense for the types of ratios that are used in different industries. And as a quick example, in the retail industry, an important ratio is the same store sales change, because if you are a retail analyst and you are evaluating a particular retail company, you want to know how the sales are changing in a particular store, because when revenue is going up, very broadly speaking, revenue could be going up because more stores are being built, or revenue could be going up because the sales from a given store or the sales on a per store basis are going up. Clearly, you would get much more excited if the sales on a per store basis are going up. In the banking sector, a very important ratio is the CAR, or capital adequacy ratio. This gives you a sense for how much capital a company, in this case a bank, has relative to the risk that it is taking. I don't think you need to know the details of this ratio, but again, the high level point here is that in every industry, there will be some specific ratios that are extremely relevant for that industry. Credit analysis. This is an item that will be covered in detail when we do fixed income analysis. And within fixed income, there is a full reading on credit analysis where this material will be covered in detail. But very simplistically, credit analysis is the evaluation of credit risk. When you are evaluating whether or not to buy a bond issued by a company, one of the items that you are concerned with is what is the probability of a default? What is the credit risk? What is the risk that the company that is issuing the bond might default on coupon payments or even the principal payment? And as you might expect, among many other tools, ratio analysis is important in evaluating credit risk. The curriculum gives several ratios, but I'll highlight what I think are the most important ones. EBIT, interest coverage ratio, where you are looking at EBIT relative to the gross interest, is extremely important. A high number can make you feel comfortable that credit risk is low, and some other ratios include EBITDA over gross interest. And then debt to EBITDA. Here, ideally, you want relatively low debt divided by EBITDA, and you want relatively high EBITDA. EBITDA is a rough measure of how much cash the company is generating. So if the debt level is low and the amount of cash or EBITDA is high, then you have a low ratio. Low ratio would imply relatively low credit risk. The debt to equity ratio is a solvency ratio, which we've talked about before. And here, ideally, you want relatively low debt, relatively high equity. So overall, a low ratio will make you feel comfortable. Business and geographic segments. Often, as an analyst, we need to evaluate the performance of underlying business segments. If you take a business like General Electric, this operates in several different segments, and you want to evaluate how each segment is performing. Let's say that a company has 3 different segments, and you evaluate that A is doing extremely well, B is average, and C is underperforming. Then a company announcement that it's going to discontinue or spin off C is going to be taken as positive news. If you look at the various ratios, these are simply ratios that you have studied before, but they are expressed on a per segment basis. Even though companies are not required to publish financial reports on a segment basis, but both IFRS and US GAAP require disclosures related to each business segment, and there are details in the curriculum about exactly what needs to be disclosed. Finally, Section 8, Model Building and Forecasting. I have captured the essence of what is explained in this picture. In order to come up with a model which predicts future cash flows, we need to forecast. The most important item to forecast for a given company is the sales numbers. Then we can look at expected ratios such as the gross profit margin. If you have a prediction for the gross profit margin, or you have an expected gross profit margin based on your evaluation of the company, then you can use the forecasted sales and your prediction of the gross profit margin to come up with your estimate of cost of goods sold. And then you can come up with the gross profit. Similarly, based on other ratios, you can predict other items on the income statement, and eventually you can predict the net income. So using this method, you can come up with forecasts for net income. You can use the same concept to come up with forecasts for cash flows. And then once you have these forecasts, you can then try to come up with a valuation for the company that you are evaluating. That brings us to the end of this reading. A quick summary. It is extremely important that you learn all the ratios, and here are the various categories that we have talked about. In general, you can use these techniques to remember the ratio. I have discussed these before, so I won't say them again. The job for you is to make sure that you can remember the ratios, and then you need to, as I keep saying, practice lots of problems so that you become comfortable using the ratios. Read the summary. This is not as useful as some of the other summaries because your job really is to make sure you know the ratios. Go over the learning objectives. The curriculum has several examples. Some of them are short and sweet, but there are some examples that are pretty long-winded. I would say that if you have time, go over those examples. If you don't have much time, just skim the examples and make sure you understand the bottom line points that are being communicated through those examples. The practice problems at the end of the reading are very good. Make sure you do them and also try to practice questions from other sources. That is it.